All right, here we are. Q1 2024 market update with Jack Cowling, portfolio manager at Waterway. I'm Dan Michalk, also part of Waterway since the beginning, and Jack is celebrating his 5-year anniversary this month. So,
Excited for that.
coincidentally, on April 15th on tax day. So, not sure how that worked out, but we're glad to have him part of the team and thought we'd go through some of the kind of a summary of Q1 and talk a little bit about the market. So thanks for being here.
Oh, thank you. Yeah, happy to be here and been a good 5 years.
Yep. And you have coffee to go with it. So how better to
Even better,
start the
even
day.
better.
So looking at Q1, we had really strong performance coming off of a really strong November and December of last year. If you had to put maybe, the first quarter summarize it in one word, how would you describe Q1 in the markets in 2024?
Well, I would definitely use the word volatility and underscore that. I mean, I think everything ended up pretty well in terms of financial market returns, but there was a lot of things that happened in between. A big one, of course, was the fact that growth overall or growth expectations held up. Consumer spending pretty resilient during the quarter. We just had some manufacturing data that came out that showed that the economy is actually doing, pretty well overall. But considering that investors really backed off expectations that the Federal Reserve was going to be cutting rates, perhaps as quickly as they originally thought going into 2024. So we actually saw interest rates back up a little bit, which did add to some volatility, particularly in bonds. But at the end of the day, if you own a diversified portfolio of stocks and bonds, you probably did quite well in the first quarter, but there was a lot that happened in between. So volatility is something that I would underscore.
Yeah, absolutely. To see, a change from last October when the Fed said we're going to cut rates to where we are today is hard to
Yep.
imagine,
Yep.
a move like that in such a short period of time.
Well, I remember back in the fall, people were expecting maybe 7 rate cuts and starting in the spring. And here we are already going into the second quarter. And now we're looking at maybe a cut in June. So, definitely things have changed and that's added to the overall volatility. But why also, we caution clients to exercise discipline as well.
Yeah. Well, we've been in that rate camp that's saying probably not going to get the cuts. Originally, the Fed, yeah, as you mentioned, 7 cuts. We've been on the camp of saying probably less cuts and probably not as often or not as soon as what the market is anticipating. If you think about inflation, where do you see inflation longer term? Not so much like this quarter or next quarter, but where do you think the long-term inflation rate ends up, and what do you think interest rates, how they follow accordingly?
Well, I don't think we're going to see inflation rates go down to zero. 2 to 3% is probably a reasonable expectation going forward, and I think that's been largely priced into bond markets. So that being said, interest rates are pretty much probably where they should be. You shouldn't expect long-term rates to decline much further if inflation is going to be sticking in that 2 to 3% range. So that's, the good news for retirement investors is that the coupons that they can earn on bonds are a lot more attractive than perhaps we've seen in a whole generation of investors. So that's kind of the good news. But on the flip side, inflation is sticky. It's sticking around. And so we don't really, look at inflation as going back down to pre-pandemic levels when it was well below the Fed's target of 2%.
Yeah.
There's just a lot of factors that I think help, that are going to help keep inflation a little more elevated going forward. And so, higher for longer, you can also look at it as just more kind of a return to more normal interest rates, which again is pretty good, I think, good news for long-term investors who invest in bonds.
Yeah. So if we think about returns, 22 was a rough year in the markets. We saw 22, hurt bonds and stocks, which doesn't always happen. Typically, there's not as much correlation there. But then in 23, we saw a huge rebound in stocks. and then also a nice return on the bond side.
Yeah.
If you think about the 10-year bond, it's trading at about 4.3%. What would you say, long term, where would you see 10-year bond yields end up down the road a year or two from now? What would you expect?
Well, so with inflation probably in that 2 to 3% range, Dan, I don't think you're going to see as big of a drop in long-term interest rates from current levels. So I think bonds are actually pretty reasonably priced when you look at treasuries. You can go out and buy high-grade corporate bonds. So, these are the blue chip type companies that issue debt. And so those are going to offer you a little bit more bang for the buck.
Yep.
So we wouldn't be underweight bonds because the coupons are more attractive and you are earning some return in excess of inflation. So, definitely don't see rates spiking up that much, but also you could see it level off between 3 to 4%. And we're not far off from that just in terms of long-term interest rates.
Yeah. So maybe 2 or 3 cuts, and we're probably where we need to be from a long-term rate perspective.
And that's, I think, where the market is at. So the market's gone from thinking about maybe 7 rate cuts to now thinking more in the 3 range. And we actually saw long-term rates adjust pretty rapidly back in the fourth quarter of the year. So, I think investors have already gotten a little boost from that. And so there might be some territory where bonds can even appreciate a little bit more, which would be great. But I think the Fed's going to have to start cutting rates before we really start to see that happen. And we also have to see the inflation numbers at least stabilize. And I think that's part of what the Fed is looking at, as well as the markets.
Yeah. Yeah. So thinking about, on the bond side, basically we were flat for Q1. So give me an idea of what kind of returns we saw on the stock side for Q1.
So really, we talked about volatility as being kind of the one word that came to mind, but at the end of the day, stocks did really well in the first quarter. And so it was led by U.S. large cap stocks, up around 10%, which is one of the best quarters that we've seen in years. A great start. Even international, which there was a little bit of a dollar drag there, showed very good returns, posting mid to high single digit returns there. So if you were invested in diversified portfolios of stocks, despite all the headlines about interest rates and everything else going on, stocks actually did quite well. And so that added to the incremental performance of people that owned a balance between those two asset classes. So overall, just a good start for the year with stocks in general.
Yeah. Yeah. Thinking about small cap, that's an area that we've seen that's been undervalued for a long time. Where do you see things moving in that direction? Earnings have been good, right? I think that's part of what's holding up the market now is the market was very dependent or seemingly dependent upon a lot of interest rate cuts. Now it's kind of pivoting a little bit and looking more at earnings. Where do you see earnings, especially like I would say the small cap area? What would you see happening in earnings there if the economy continues to recover like it's looking like it is?
Well, with the recovery in the economy, but also earnings sentiment being positive, that's actually great news because a lot of what was driving the generous stock returns back in 2023 was just really a handful of names. I could count them on 2 hands. Now what we're seeing is that there's a little bit more of a broadening effect in terms of the types of companies and sectors and market segments that are participating in that recovery in Q1. And so, I think that's probably going to continue as long as we don't have a really big change in growth expectations. The risk to that, of course, is that we have a hard landing type scenario. But the data really doesn't point to that right now. So, as a result, I think you're going to see that rally continues to broaden to those names or those companies that really didn't participate as much in 2023. And that's good. That's good news, I think, for most investors.
For sure. Definitely positive. So I noticed sector-wise, surprisingly, energy was the number one performer, being in Texas. We definitely, benefit from that. But also financials had a really strong quarter. And so I would say, one of the conversations we're hearing a lot from clients is around technology and companies like, NVIDIA with AI. We're obviously invested in those. We're not overweight, but we're invested in those across ETFs and mutual funds.
Absolutely.
But where do you see things going with AI, and how does a person buy in? And I'll use the analogy of I remember in the 1990s when the internet first came out.
Yep.
Netscape was the largest dominant browser. And it was early on, and I want to say they had 85-90% of the market share. And if you think about it today, they're not even in business. But that's kind of what AI reminds me of right now. Is it's very, I think it'll be very, it'll be impactful across all types of industries and sectors, especially those jobs that are routine and mundane and very labor intensive. But where do you see things going from maybe an investment perspective of how do we benefit from that and find companies that are actually making money?
So I think with AI, that's an interesting field, and it is, I think, a potential game changer. We've already seen companies adopt AI and embed that into their workflows and customer service processes. So it's a very interesting field, and I think a lot of those companies, like NVIDIA, for instance, I mean, they're up over 80% this year. That does feel a little frothy to me, but also there are a lot of, I think, growth opportunities there. And to your point, though, being able to select the winners and losers, I think, is going to be a little bit more problematic from a portfolio perspective. So, I always go back to the principle of diversification. You want to have, you want to have exposure to these more innovative areas of the economy, but at the same time, just realizing that the winners that kind of start out at the kind of the first wave of this aren't necessarily or aren't even likely to be the ultimate winners and are able to capitalize on some of these trends. So, there's a lot that can happen over the next few years just in terms of AI adoption. Mm-hmm. And so, it's going to be interesting to see what happens, but there's also a lot of uncertainty about how that happens and, who ultimately is going to be, the winners and losers in this trend. So again, diversification, that helps really, I think, avoid some of the extremes of investing, both the upside and downside. And so for us, that's probably a more safer way of playing it. If you have an S&P 500 index fund in your portfolio, you're going to participate in these names, but you're not going to see that volatility as well.
Mm-hmm. Yep. I think it's a part of everybody's common concerns is how do we participate? And yet some people fear it, that it will disrupt a lot of industries and jobs. And I think it's going to have pros and cons. I can see good actors using it for good. I can also see bad actors using it for bad, just like the internet, 25 years ago or so.
Yeah. Well, oftentimes I think innovation leads infrastructure. And so, this is no different. Of course, companies are trying to, and policymakers too, are thinking about, how do we manage this and how do we embed this into our business process management, and what are some of the governance structures around that? Can human beings kind of mediate that output? And, can also, is it more kind of transparent in terms of the underlying algorithms? And so AI is kind of viewed as this this black box, but depending on what the methodology used, there could be a little bit more transparency, and I think ultimately people will demand transparency, and so there's going to be, I think, probably some regulation around that, and a lot of these things are just still unknown. So again, I think that really speaks to the need to diversify your bets. Still participate in it. Which I think investors that own a diversified portfolio will do that, but avoiding some of the big risks associated with names that may not be here 10 years from now.
Yeah, totally. And even the secondary players, as you were mentioning that, I thought about the trickle-down impact of, a hardware refresh. So there's a button on your, laptop or on your cell phone to hit a button, and that pulls up AI. So a hardware refresh on devices, just thinking about communications back to cell towers, because so much of our content now is driven mobile on mobile platforms.
Yep.
So cell towers, upgrading the equipment at cell towers, and then those cell towers reach out to the data centers, and what are data centers doing with their infrastructure. So I think there's a second layer of maybe a safer way to play that expansion too, where you're not at the tip of the spear, you're maybe back off a little bit.
Right.
You might not have huge outsized returns, but you do participate in what will likely be a multi-year,
absolutely,
a return potential.
Yeah, it also kind of works into the reshoring argument. So companies are looking at supply chain risk, and they're looking at whether or not it makes sense to manufacture in some of these countries where there's vast distances between the manufacturing and ultimate consumer. And so I think part of what we'll see from this is more of a potential reshoring of some manufacturing where that automation is possible through AI. But you're still going to need skilled people to be able to run the factories and be able to troubleshoot and be able to interact with the AI and automation. So it's very exciting in terms of the potential productivity, but also some of the other kind of ancillary services in companies that will obviously benefit from the adoption of automation and new technologies like AI. And again, I think one of the best ways to participate in that is to diversify. And that way you still participate, but you're not taking kind of these outsized bets in any one particular company.
Yeah, removing the extreme outcomes on both ends of the spectrum, big positives and big negatives.
Exactly.
Yeah, that makes sense. Yeah. So thinking about the rest of 24, one thing that we have gotten asked over and over is what's going to happen to the markets in November. That's the hot topic. Is how are we prepared?
I was waiting for this question.
You knew it was coming. We get it almost daily. Is how are we prepared? What do we think is going to happen? And historically, what do we see outcome of elections doing to the markets?
Well, that's an interesting question, and I take the perspective of that elections do matter, but it doesn't necessarily matter to your portfolio returns. So that being said, if you look at the historical evidence and looked at market returns over both Democratic and Republican administrations, at the end of the day, it's kind of a coin flip. And so, I would caution against making big financial decisions based on the outcome of elections, particularly if you do have a diversified portfolio. Certainly, government and policymakers can pass policies that essentially tilt the odds in favor of one company versus another. And, whether you kind of believe in that or not, that's a good thing, it does happen. But when you start looking at more diversified portfolios and you start spreading your risk across different companies and different sectors, different markets even, that becomes less of an issue in terms of what is the primary return drivers. And ultimately, what we found historically is that companies can make money regardless of who the administration is. They're able to adapt.
Yeah.
And so I would call, elections are interesting. It's fun to kind of keep track of that. But at the end of the day, from a portfolio perspective, that's not really the primary driver of returns.
Yeah.
And so that's not a big weight in how we, rebalance portfolios and make decisions and what goes into the portfolios.
Yeah. And actually the stronger statistic that drives, if you look historical perspective, is that a divided, White House is controlled by one party and Congress is controlled by another is actually a scenario that has the best market returns historically. And people would say, well, a president needs to be Republican. They're more pro-business.
Yep.
But the facts actually show the opposite.
That's true.
Is that under a Democratic president and Republican Congress, that's actually been the best historical market returns that we've seen, which is kind of interesting.
Yeah, I'm not surprised that split government might be the best scenario for stocks, only because it avoids kind of the extreme policy making decisions on either side. So I think markets like certainty.
Yeah, true.
But at the end of the day, big policy changes, companies will adapt, but at the same time, there's more to it than just who's, in Congress or who's in the White House. And so, I'm not surprised by that.
Yep. Okay, so thinking, trying to get in Jack's head a little bit deeper. I know this is kind of a scary question, but what keeps Jack up at night? Thinking about the financial system, government debt, running deficits like we are. What would you say is one thing that maybe keeps you up at night when it comes to investing?
Well, one of the things that does concern me is just the level of government spending coming out of the pandemic, which, looking back, it did help, it did help the economy having that support, but there was never kind of this idea that we would have to pay that money back.
Yes.
It wasn't a loan as much as, a transfer payment, which, ultimately I think did lead to some of the inflation that occurred. And so, I think the government spending probably does portend probably this higher for longer interest rate environment if you look at what was, going on there.
Yep.
So that does concern me, and neither party seems to have a solution around that. And also just the fact that the world seems to be a little bit more correlated.
Yeah.
So, the traditional, free lunch, if you will, that investors had was that they could buy a portfolio of stocks and bonds. And when stocks were zigging, bonds were zagging, or vice versa. And so there was some hedge there. So, now I think we've seen that, since the pandemic, that the correlation between stocks and bonds has actually increased.
Yep.
Which makes it a little bit more difficult to, I think, diversify and to hedge against stock market risk. And so a lot of what we do at Waterway is thinking about how do we manage risk, more actively so that we're taking into account some of these underlying changes. Now, whether or not that's going to be, a permanent feature or just kind of based on where we are in the cycle, we'll see, but I think just getting a little bit smarter around managing risk and how we diversify is going to be key, because the traditional ways, although they might still work, maybe aren't quite as effective as they were 10 or 15 years ago.
Absolutely. We saw that in 22.
Absolutely.
A lot of correlation during COVID, so definitely agree with that. So looking forward, not asking for a hot stock tip, but when you think about our portfolios today for clients, what are the areas that you feel like are maybe the most attractive or might actually become more attractive as we move forward? What space do you feel like is underappreciated, maybe not talked about enough in the portfolio that not necessarily right now is going to make a change, but long-term return-wise, what do you think is going to be most additive as we look out maybe 1, 3, 5 years from now?
So I think that's a good way to look at it. So we like small cap stocks, which have underperformed their larger cap cousins for several years now. And so, as we see the rally broaden and economic growth expectations stabilize or even improve, that's good news for smaller cap stocks. And so those are trading at valuations that we haven't seen since really the last major recession.
Yep.
And so those companies are, relatively cheap compared to the top names in the S&P 500. And, focusing on the profitable, areas of that market, I think is one way to kind of play that. And, we've certainly tilted a lot of our portfolios into those areas to take advantage of that. Another area is just the large cap dividend payers. It may not be that, the most exciting names that you see on the front page of the Wall Street Journal.
The slow and steady.
But the slow and steady often wins the race.
Absolutely.
And so, these are dividend payers that are generating excess cash flow. They have a high level of profitability. And so being able to find those names in each sector, I think, is another way of playing it. And sometimes the value of those profitable companies is sometimes underappreciated, relative to kind of the more frothier growth names where, you're pricing in growth expectations far into the future and a lot of things could happen in between, things could go wrong with that. So I think there's a certain margin of safety in kind of sticking to those larger, more profitable stocks.
Yeah. As we all know, the future can change and be very different very quickly than what we anticipate.
Absolutely.
Excellent. Well, thank you for your time. It's been great to catch up. Congrats on your
Likewise.
5-year anniversary.
Thank you very much.
Waterway.
It's been awesome.
And hopefully we'll have some more good news to report in Q2. It'll be here in about 90 days, and we'll look forward to doing it again. So thank you, Jack.
Perfect. Sounds good. Thank you, Dan.
Cheers.
Cheers.